Well, we always say retirement is a journey, one that you shouldn't have to navigate solo. So that is why every week here on The Right Path to Retirement, we turn to financial advisor Jimmy Lynn, certified financial planner and the founder of Right Path Wealth Management right here in Las Vegas. Now, while the stock market has been on a nice run lately, there is a warning from history that might make investors a little cautious that I want to chat with you about, because the summer months in midterm election years have often been a rough stretch for stocks. So a lot of people are wondering if we're going to see that same pattern happen this year. So I'm wondering, Jimmy, if you can speak to what history has shown us and how you help your clients avoid making the wrong move at the wrong time. What are your thoughts?
Yeah, I mean, we are in, the midterm elections that are going to be in the fall. So we're in this kind of strange period of time where people, aren't, even when you're watching financial news, they're not necessarily focused so much on how companies are performing, their earnings as much. The spotlight has shifted to what's going to be going on in the elections coming up in the fall and what policy changes can affect the overall economy. So it gets a little tricky because we're basically in a period of uncertainty. And we all know that any type of uncertainty in the market typically will create some down cycles. And that's what we've seen historically. If we look at over time, we've had some of the biggest drops during this on a midterm election period. And consistently, the S&P 500 seems to be on the lower end or not doing as well during these summer months as we kind of lead up to the midterm elections. And like I said, there's a couple different reasons. A lot of it is just because of the focus on policy changes and the uncertainty. But for us, we try to insulate our clients from that by having a plan. Like, you should not be tied up to the day by day, week by week changes in the market based on the news cycle. Because if you are, Casey, quite frankly, you probably don't have a proper plan. You want to make sure that your plan is not built for a 3, 6, or even 1 year period. Your plan is something that is built and planned out methodically for a 10, 20, and 30-year retirement period. And when you look at it that way, you should be able to ride out the ups and downs of the market. Now, what we've done, and actually, I'll tell you, we had a prospect recently come in, and they had some of these same concerns. They're like, the market is going a little bit volatile recently. Kind of talk to them about how, these summer months, we do see some drops historically speaking. And they were concerned, rightfully so, because they're preparing for retirement. We use a strategy that we really like. It's not necessarily great for everyone, but in the right situation, I think it makes a lot of sense, from an emotional standpoint. But this prospect that we're talking about, they've done really well in their 401k just by pretty much doing nothing, right? Because the market, if you leave the money in for an extended period of time, typically it's going to just do what it's going to do, as long as you're not messing with it, taking money out at losses, things of that nature. But during your working year, we typically don't touch our 401ks. And so what we talked about is, hey, look, why don't we lock in these gains that we've had? The great market that we've been experiencing over the last 10 years. How about we lock in some of the gains so that we're not as afraid or worried about this kind of volatile period that we're in? If we lock in some of those gains right now, and then just every year we'll just re-enter the market. That's a concept that we've talked about in the past, Casey, called dollar cost averaging. And it's something that people do during their working years. Like you and I, we don't think about it, but every, 2 weeks, we're putting money into this retirement account. And so we're getting the average of the market. We're consistently putting money in. But during retirement, when you're no longer putting money in and you get a big market drop, it can actually, obviously negatively affect your long-term plans. So we actually suggested a strategy that they're going to be implementing where we ended up taking their 401k, locking in those gains, and put that into an index annuity. And they got a nice bonus on that. And now every year we're going to put that money back into the market. Reason why I bring this up, Casey, is because there are strategies where if you don't want to lose all those gains that you've accumulated, there are ways where you could still take advantage of the market, but have some money in there that's not kind of exposed to this market volatility.
I'm wondering, Jimmy, if this type of seasonal volatility matters more for somebody who's nearing retirement, let's say, they're 5 to 10 years out versus a younger investor? Does it matter more for those who are getting closer to retirement?
That's a great point. I mean, yeah, obviously, as we talk about this, our sweet spot are those people that are a few years from retirement or into retirement. If I'm talking to somebody in their 20s, 30s, even 40s, the market volatility, not as important. In fact, you're typically getting your investment set as a discount every time there's a moment of volatility where the market is down. But the one thing that we lose as we're going into retirement, we have less time on our hands. We are going to be using that money sooner. And so we don't have the same amount of time to recover. Oftentimes we're not working, so we're not putting money in to take advantage of that dollar cost averaging of buying low. And so this is the point, and this is why people come in and they're more concerned about what's going on in the market, and they see this volatility during this kind of strange period with the midterm elections, is because they don't have that time on their hands anymore. And there's this famous saying with Warren Buffett, actually. He said that if you're not willing to hold a stock for 10 years, then you shouldn't even be owning it for 10 minutes. And the thought process behind that is just that the stock market and your investments there are for the long term, because there's going to be this built-in volatility. And the important note is really for people to have a plan where those investments are working for the long term, that money in the market, but then have another strategy for that income that you need over the short term, over the next 5 to 10 years, so that those vacations that you want to take to Europe or to Asia, they are not tied to the performance of the market. And that's the biggest kind of puzzle piece that people struggle with, is that they know they've done well. They have money in their portfolio, but then how do we spend this money and still participate in that market growth? Because they want to grow their money. Inflation is a real thing, but they want to take vacations too. And they don't necessarily tie those two together. So having a strategy in place where you have your long-term money, like Warren Buffett says, that 10-year plus money, and then having some of your assets put in a place where you can actually rely on it for those vacations in your lifestyle. That's what true proper planning is. So that's a lot of what we do in our office, Casey. When we do these discoveries calls, we can kind of point people in the right direction. If anyone wants to kind of schedule that and have this conversation and get that started, they can reach out to us at 702-744-8344, and I'd love to chat with them.
So let's give our listeners some tangible advice to take away from this conversation. Jimmy, what is one mistake that you would caution our listeners to avoid if we do end up seeing that summer slowdown that past midterm election years have shown us?
Well, what you don't want to do is, when you see this market drop that, traditionally comes, historically speaking, you don't want to sell off and lock in those losses. Because once you sell off, lock in those losses, put it in cash, you're no longer able to recover. And that's the biggest impact. So having a strategy in place, making sure your assets are allocated properly so that you're not relying on this money that could potentially drop. That would be the first thing. It's really just having those pillars in place of giving all your dollar bills a job. And then the market cycles don't give you as much anxiety when you watch it on the news.
So is the bigger risk here, Jimmy, the market volatility itself, or how investors react to it? Because I'm taking away from this conversation that it's the latter.
It is the latter, because the markets are going to do what they're going to do. We're going to see ups and downs from a micro standpoint. But when you kind of zoom out and look at the market, it typically always trends up. You're just going to have moments of recession that you have to be prepared for. And so when you react the wrong way, which is if you're set up in a plan that you don't understand, you may be in a good plan, you just may not, it hasn't been explained to you, the different pieces and why they're there. And so if you don't understand that, you may just think you have to sell off because you can't take those losses. And that's where you really get impacted. So it is definitely the latter of people wanting to make sure that they have a plan where it is going to be set up in a way where they will not overreact, because they understand the plan. So it all centers around planning, but not just having the plan, but understanding the plan, understanding the purpose. And that's what's really important to us, is because when we work with clients and we get on these calls, we come from a standpoint of education, not telling people what to do, but actually explaining what we suggest and why they should do it.
That is going to do it for us this week. We will be back next week, same time, same place, with more great insight from certified financial planner Jimmy Lynn here on The Right Path to Retirement. Take care.
Insurance products are offered through the insurance business Right Path Wealth Management. Right Path Wealth Management is also an investment advisory practice that offers products and services through Impact Partnership Wealth, LLC, a registered investment advisor. IPW does not offer insurance products. The insurance products offered by Right Path Wealth Management are not subject to investment advisory retirements. Investing involves risk, including potential loss of principal. Any reference to the protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims paying ability of the issuing carrier. This radio podcast is intended for informational purposes only. It's not intended to be used as the sole basis for financial decision, nor should it be construed as advice designed to meet the particular needs of an individual situation. Right Path Wealth Management is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by Right Path Wealth Management.
Market Guard is a firm that provides investment signals as well as portfolio allocation recommendations, wide variety of model portfolios. Market Guard does not offer advice or enter into fiduciary relationships.